join, but welcome everyone to NLC's free webinar series. Very grateful for James to be joining us today. I'll let him introduce himself, but I just wanted to quickly go over some rules of the road. James, if you want to hit the next slide for me. I'll read some of these and then let James get started. But to minimize background noises and distractions, all lines are muted for the duration of the webinar. This session is being recorded, and then we'll be posting it on our website in the next few days and sharing the recording with everyone to your emails, as well as the slide deck. I have enabled captions here through Zoom. If they're just a distraction, feel free to disable them by turning them off on the settings in the bottom. We warmly welcome your questions, and James will take the last 5 to 10 minutes to answer any questions that come up. So feel free to write them in the chat box, and we'll be sure to answer them at the end. In the meantime, feel free to start sharing your name and what organization you're with in the chat box so we can see who's joining us today. But we're so delighted to have James with us, and we're looking forward to a great informative webinar. On to you, James.
Thank you. Hi, everyone. Thank you for joining me today on today's investment policy webinar. My name is James Cho. I am an associate at Your Part-Time Controller, or YPTC for short. I've been working with nonprofits for over 5 years. I started as a controller at a church and have been with YPTC for over 3 years now. And in my previous life, I spent 14 years working in the hedge fund industry. So yeah, as Isabella mentioned, just feel free to drop in your name and what organization you're from. And if you have any questions during the presentation, you can drop those in the chat as well. So here are our learning objectives for today. So at the end of the webinar, I hope you have a better understanding on why nonprofits invest, have a better understanding of what an investment policy is and what to include in this policy, and have a better understanding of Florida's UPMIFA and how it relates to your financial statements, your 990, and your organization overall. So to achieve the learning objectives, for number one, we will review some concepts and then go over some scenarios that will reinforce those concepts. For number two, we will define some elements to include in your investment policy and highlight other things to consider when preparing or updating your investment policy. And then number three, we will highlight some parts of the UPMIFA, and we'll bring everything together at the end with how your investments and your investment policy impacts your financial reporting. So we'll start off, with the question, why do nonprofits invest? And we'll look at some common reasons why nonprofits invest, and we'll go through some scenarios to reinforce those learnings. And here are 4 common reasons why nonprofits invest that we'll go over in this presentation. I mean, there are many more, but for today, we'll just focus on these 4. So number one is a donor restricted gift or endowment. So these are gifts, usually large gifts coming from a donor, and they have some restrictions, and the restrictions are, you have to keep the principal, the corpus in perpetuity. Any investment earnings can be used, as the donor wishes. For this number one, endowment gifts fall under the UPMIFA statute, so we'll hit that later on in the presentation. But yeah, so donor gifts for endowment is one reason why nonprofits invest, because they receive a large donation and they have to keep that, in perpetuity, and they have to, only spend the investment earnings. So number two is excess cash. So, nonprofits who are, have cash balances that exceed their operating expenses, they have enough funds to cover their current expenses, maybe have a little bit left over for emergency funds, but then they have a little bit more on top of that, and they're, have the opportunity to invest for the future. So they have kind of a longer time horizon. There's no like upcoming expenses or known expenses that are coming up. So they can just, start investing as they need, what they think is best for their future. So number two is, a nonprofit invest because they have excess cash. Number three, board designated. So this one, a little bit similar, but the time horizon's a little bit shortened. The board, nonprofit board or staff, or they kind of expect an expense coming up, right? So they need to create a reserve. They need to, invest because, at the moment they may not have the full amount for the future expense. So in case of a building improvement, a quick example, it's 5 years. Your organization feels like they need to do some building improvements. They currently have, say, 25,000, available, but they need to get to 100. So, with some good contributions, in the next 5 years and some good investing, they can get to their goal. So it's like a third reason why nonprofits invest. And number four, short-term investments, very similar to board designated, but there's a little bit more short-term in nature. If a nonprofit has just funds sitting in their checking account and it's better off moving that into, say, some CD accounts or money markets and so forth. So now that we've gone through these examples or these explanations, we'll go through some examples of why nonprofits invest. So I'll just read off each scenario and then give some thoughts afterward. So here's scenario one. The nonprofit We Love Cats and Dogs is having some cash flow issues. The nonprofit's monthly lease will increase at the end of the year, and it realizes that the organization cannot sustain paying its high rent. One of their generous donors provided a $1 million contribution with the restriction that the nonprofit has to keep the principal in perpetuity, but can use the earnings to help pay for rent. What recommendations would you give to their CFO? So here are our thoughts. We Love Cats and Dogs has received a generous donation. It would be in their best interest to keep the principal in a safe investment with predictable returns. The nonprofit will have to factor in future rent increases and be careful not to be too aggressive with their investment. So kind of in this example, the lease kind of is a good model to, how they would want to, use their endowment gift to help pay for their rent. So they have some known future rent escalations, and that can kind of be factored into how how they want to invest to cover some of their rent. So, if they want to be, a little bit more aggressive, they can say, we want to earn investment income to cover 100% of our rent, or, if they're a little bit more conservative, if they want to cover 50% of their rent and so forth. So, these are all discussions you'll have with an investment advisor. You'll have some discussions internally to see what's best way to move forward with this gift. So scenario two, example of excess cash. So the nonprofit We Love Cats and Dogs has been successful fundraising and sticking to its budget for the past few years. The nonprofit has a lean staff who are all working at full capacity. The nonprofit has enough cash to fund its operations for the next 3 years. Then out of the blue, the nonprofit received a $25 million unrestricted donation for general use. What are some things that the nonprofit should consider? So the nonprofit staff and board should collaborate to create an investment policy that will further the nonprofit's mission. The sooner the nonprofit can create an investment policy, form an investment committee, select an investment advisor, the sooner it can put the 25 million donation to work and start generating investment income. So this is, loosely based on one of my clients. In my client situation, the nonprofit, was very busy. They were had a lean staff. They were all working, long hours each day. And it took about almost a year to finally get their investments into, that $25 million into an investment account. So, the lesson here is that it takes time, and you can start educating yourself or start asking questions. If this situation did come about, what would we do? So, this is in this example, nonprofit has excess cash and that's not needed for the short term, so it can invest in its future. Scenario three is a board designated unrestricted fund. So Recently, the nonprofit We Love Cats and Dogs has been incurring excessive repair costs for its van, and it seems the repairs are happening more frequent as well. The ED and the board agree that the van is on its last legs and will need to be replaced in the next 3 to 5 years. The anticipated cost for the new van is $75,000. The nonprofit currently has only $50,000 available to purchase a van. What recommendations would you give to this nonprofit? So here are our recommendations. The nonprofit has 2 ways to finance the purchase of a van. The first is to borrow the funds and repay the loan over time. And the second is to create a board designated fund. The board can invest the $50,000 and then determine how much additional contribution and investment income will be needed to increase its funds by another $25,000 over the next 5 years. So, the mechanics kind of this example is very similar to a 401k plan. So, if you make your periodic contributions, and then you do some good investing, hopefully you can meet your goal when you are ready to retire. So, answer that question, why do nonprofits invest? And in this example, nonprofit has a future expense and needs to invest to help finance this van. And lastly, scenario 4, short-term investments. The nonprofit We Love Cats and Dogs has an excess $500,000 that is sitting in its checking account. Nonprofit would like to keep these funds liquid in case it experiences a large unexpected expense. What are some options for this nonprofit to consider? So the nonprofit can move the funds to 2 separate bank accounts and park $250 at each institution to stay in line with the FDIC threshold. And keep in mind the $250 FDIC limit is per banking institution and not per account. The nonprofit can also move $500,000 to an investment account and invest in safe and liquid investments. The investments will not fall under FDIC. It would fall under SIPC, and SIPC, as it's known, covers investors up to $500,000 in case of brokerage failures. So that's not $500,000 in bad investments. It's in case your brokerage fails, they will help you recoup some of your assets. So we went through 4 examples, and I think most of the nonprofits can identify with one or more of these scenarios. So I'll be referring to them throughout the presentation. So, just try to remember these 4 examples. So before you can start investing, you'll need an investment policy statement, and that outlines anything related to investments. So it should help any new board member like ED or CFO and so forth to understand the who, the what, the when, or how to do anything that relates to your investments. So the investment policy is, the playbook for your organization's investments. So we're going to go over 10 things to include in your investment statement. So these are coming from ECIO. ECIO is a financial advisor, and they put out some good marketing material. So instead of reinventing the wheel, I just grabbed this right from their marketing material. So, what should you include in your investment policy statement? Number 1 is your statement of purpose. So, you want to describe why you're investing, what your goal is, what you're trying to do. And these are, more qualitative in nature. If you want to refer back to, the example we just went over with the $1 million contribution to help pay for rent, if that was your only investment, the $1 million, you just want to kind of document, hey, we received a $1 million contribution endowment gift. We would like to preserve that endowment in perpetuity. At the same time, we would like to receive some investment income to help pay for rent and so forth. So, that's a good way to state the purpose and how that helps further your organization's mission. Number 2 is your investment objectives. This kind of is a little more quantitative. So, going back to the $1 million endowment gift, if you want to say your objective is to receive a 7% return, you want to receive, say, 50,000 or so in income. So that would be 5% would be just jumping ahead to your spending policy. So that's kind of your objectives. What are you trying to achieve, quantitatively? How much income are you trying to generate? How much risk are you willing to take? If you're trying to generate 7% income, are you okay potentially losing 7% as part of the risk, right? So that should be outlined in your investment policy statement. And then your spending policy is how much will you withdraw? How much distributions will you take from your investments? Just again, using that $1 million example, if you're trying to achieve 7% return and you would like to, keep the donor's intent and wishes intact, you would not pull out 7% or even more, 8%, 9%. You would take a lesser amount, help preserve that endowment gift to last in perpetuity, but also help the organization, use some of these funds to offset some of their operating expenses. The next set of three kind of relate more to what you're going to actually invest in. So number four is your asset class guidelines. So these are the specific assets that you're going to be buying to invest in. So that can include stuff like asset class could be like money markets and CD accounts. So it's very liquid stuff, very liquid assets. Another could be equities. So anything that's on on the exchanges that are really liquid, and you're allowed to purchase those for investments. Another example is fixed income. So you can kind of go through each asset class with your investment advisor. The asset classes, they all kind of work in hand. If your objective is to earn 7%, and then your advisor will say, okay, if you're trying to achieve 7, you might want to look at some equity, some fixed income, and some, maybe keep some investments in the CDs and money market accounts to just protect for protection purposes. So that's what you want to go through with your investment advisor to determine what is applicable to achieve your investment objectives. So what do you want to invest in? So once you decide what asset classes you want to invest in, you can now just start allocating what percentage of your say $1 million do you want to allocate to equities, what percentage should go to your savings accounts and your CDs, and what percentage should go to your fixed income. So you kind of want to have what they call a target allocation. So you kind of have a sweet spot, a sweet allocation breakdown to help you achieve your objective. So again, your investment advisor will help you put all this together once they kind of understand, your objectives, your expected return, your risk, and so forth. So, and the final one here is rebalancing. So you have your target allocation, and let's just say it's 50% equity, 25% fixed income, 25% money markets. If your equities kind of shoot up to become 80% and you have 10% cash, 10% fixed income, then you're kind of out of whack. So you want to rebalance and get your percentages back to 50, 25, 25. And you would have to do what they call a rebalance, basically sell your equities to get back from 80 back to 50 and so forth. So, you want to always try to achieve your investment objectives. If your equities are higher, you can, make more, but you can also lose more. And that's kind of the idea behind rebalancing. Number 7 is duties and responsibilities. So this is a big part of the investment policy statement. So, any reader, any newcomer to your organization, whether they're part of your staff, your accounting staff, executive director, or anyone who was on your board or part of your investment committee, you want to assign everyone their roles, make it clear, when deliverables are due, when, what they have to do on a quarterly basis, on an annual basis. So, when this investment policy gets initially created, you have your staff, you have your board, they're all kind of working together to create this investment policy statement. Your staff is working day to day. So if they're already working 8, 9, 10 hours, then to throw this extra task to create an investment policy statement, that takes time. Your board, investment committee, you have to find volunteers to potentially take on additional roles. And then they're kind of more on the monthly, quarterly kind of cycle. So, to get them to have more time to, help out in this capacity, that takes time too. So, it takes time to get people into a new groove, to a new routine of now, having investments part of their responsibilities. The next two is implementation and performance overview. So implementation relates to anything about your investment advisor. How are you selecting this person? How are you, evaluating whether this, strategy is good, strategy is bad. So you want to lay that out, whether you hire someone externally and have to pay them a fee, that's one choice. Another choice, if you're fortunate enough to have someone internally, say on your board, or someone who can volunteer and who, is a professional, has qualified, has the credentials, and experience to be an investment advisor, then, that would be great to have someone who, believes in your mission and wants to really help your organization. Then they can, kind of do it on a pro bono basis. But if you're not in that position, then you may have to reach out to someone external and have to pay fees. And then the performance review, once you select your investment advisor, you would like to review this person's performance, whether they're meeting their benchmarks, kind of agreed upon, whether this person meets these benchmarks. That will determine if they're doing a good job or bad job. So, other things to consider are whether your investment advisor, is, works well with your organization. Are they a good strategic partner? So are they adding, value to your organization? Are they helping your investment committees whenever they need help? So those are other things to consider when you're doing a performance review. Finally, number 10, it's the investment policy review. So, at the end of every year here, ECIO recommends, once a year to review your investment policy statement. So, anything that kind of comes up during the year that's not really addressed in the investment policy, you can add those new policies. Yeah, it's good to, include, not everything. You don't want this thing to be 100 pages, but, to include enough for each person to read it and just kind of point them in the right direction. So now I'll go over, spend a little bit more detail on a couple more of these. So the spending policy, the orange text here will just kind of reiterate what I went over, what ECIO is saying to include in their investment policy, but I've added a couple, a little bit more bullet points here. So when there's investments, if you get it from different sources, it's usually put into one investment account. So if you have, say, 5 donors, 5 endowment funds for 5 different people, you can kind of grab that $5 million and put it into one investment account. That's called pooling, and that's okay, right? So it gets a little bit, I would say a little bit messy when the donors wants their gift to be treated differently. So an example quickly is if you have 5 $1 million donations from 5 different people, and to calculate the spending policy, you would say we will take 5% of the 5 million, and that's how we're going to distribute for the year. So that 5% of 5 million is $250,000, and that's kind of the quick way of doing a spending policy. If one of the donors says, I would like you to only take 2%, then you cannot apply that 5% to that one donor who is a 2%, right? So therefore, you now have uneven kind of allocations. It's not pro rata anymore. So that's kind of where things kind of need to be, really monitored and make sure you're calculating everything correctly. And that's where good accounting kind of comes in. Another issue is like if a fund is underwater, how does that affect your spending policy? So, in your investment policy statement, you may want to kind of address these kind of situations. If a fund, is $1 million gift, now it's worth, say, 900,000, do you continue to pull 5% out of their fund? That's up for discussion. There's no right or wrong answer. For asset class guidelines, Your advisor, like I said earlier, will kind of determine what assets you're going to invest in, what's the best way to achieve your objectives. It's just other choices. If you want to go a little bit more on the aggressive side, if if you have a little bit longer time horizon of your investments, alternatives are available. And you just make sure that that they require larger initial investments, they charge higher fees, and they may have lockup periods. And that basically means you cannot just join a fund in 1 month and month two ask for your money back. It's usually a 1 year or 2 year lockup period where you can have your funds returned. And you want to periodically review your investment or your asset classes, because as your objectives change, as you want to have higher returns or lower returns, then that will kind of dictate what kind of asset classes you should be investing in. Again, roles and responsibilities, kind of touched upon this a little bit earlier, but developing the initial investment policy can take time. It's kind of new to everybody, new to your staff to take on this new role of taking on investments, accounting for investments, preparing reports for like the board meetings, the investment committee meetings, and so forth. And then on your investment committee side, the board members, they're kind of more on a monthly, quarterly cycle. So, just trying to get them an extra hour out of their time, it can take some time to do that. So, just be patient, just realize that, implementing this new policy will take time, and, educating the staff is important, especially the accounting staff. They'll have this new investments, to put into their accounting system, all the reconciliations. It could be all new. So, it'll be good to reach out to the auditors, reach out to your external bookkeepers to try to get everyone educated and doing a good job. The accounting, if done correctly, will lead to good audit work papers, and will lead to good, financial audited financials, and then will then be produced onto your 990. So, and your investment advisors should be able to kind of educate your investment committee, your board, and just kind of show them what kind of reporting that they're able to produce to give them information that they need. The investment managers, so implementation. So the investment manager typically selects the custodian. So the custodian is the firm that actually holds your investments. So if you're buying investments, that would be your custodian. If you're selling, a custodian would pass it on, take it off your books, right? So the manager and the custodian could be the same person. So if in the case of if you're going with, say, Bank of New York as your investment manager, Bank of New York will most likely be your custodian. So you want to get a good idea of the reports that they're capable of. And the statements. So when you get a visual of what they look like, make sure they have all the data points for your accounting team to do the accounting. Make sure they all have the data points for your investment committees to have all the information that they need. Before you select your investment manager, it'd be just good to have that in mind. And if you want to change investment managers at some point along the line, just kind of keep in mind that when you're changing investment managers, you are now forcing your old custodian to transfer all your investments to the new custodian. It can get a little bit messy, but it just takes time for all that to pan out. So just keep that in mind when you're selecting your investment manager. And if you have multiple managers, it would just be good to even note that in your investment policy statement that you have multiple managers, because if you have staff turnover, and not everyone would know that you have multiple managers. So if you kept that in your investment policy statement, it's like one place where they can kind of reach out and contact all these managers to let them know that, hey, we have a new CFO and so forth. And then finally, number 10, this is kind of reviewing your investment policy statement. It should be broad enough where it doesn't need to be edited. It should be updated to address any kind of recurring issues. And the last point here, it's kind of the nonprofit's responsibility to be in compliance with all regulations. So I think the investment policy statement should try to capture all your regulatory and compliance obligations. So the auditors will kind of point you in the right direction. Your financial advisor or your investment advisor will kind of point you in the right direction. But if anything is not right, I think the nonprofit is ultimately responsible for being in compliance. So we will now move on to the Florida MIFA. So this comes into play again when there is a donor restricted gift, and that gift is to be held in perpetuity. So if Isabella, can you just drop in the chat that link, the Florida MIFA?
Yes.
Okay, thank you. So here are 5 FAQs, frequent asked questions about the MIFA. If you look at the link, you can see the full statute, the full regulation, and we don't have time to go line by line. So we'll kind of address it with 5 questions. So, the first question is, what is MIFA? So it's the Uniform Prudent Management of Institutional Funds Act. And it governs how nonprofits manage and spend donor restricted endowments. Nonprofits includes religious organizations. So yeah, it's anyone who's a 501c3. It's been around since 2006. So not all the states have adopted it right away, but in nearly 20 years later, we have 49 states that have adopted MIFA, and it replaces UMIFA. And UMIFA has been around since the 70s through 2006. And the main difference between MIFA and UMIFA is that with UMIFA, the old act, if your endowment went below the original gift, so if your 1 million original gift is now say 900,000, UMIFA says you cannot do any more distributions until your 900,000 gets back to 1 million, right? So that really is very disruptive to a organization. If there are just bad markets out there, it's just really disruptive for an organization to not be allowed to use funds from this endowment gift. So UPMIFA came about and says, look, you can go negative. It's okay to withdraw, but it has to be prudent. You have to have essentially a plan to get your endowment back above water, right? So if your 1 million original gift is now worth 900, maybe in year 1 you take a lesser spending rate. Instead of taking off 5%, you maybe take a 2%, right? So try to build that endowment back up. So I think UMIFA is a little bit harsh. UPMIFA allows organizations to be prudent, to think long term, gives them the flexibility to kind of use that in perpetuity timeline to get their original gift back up to what the original value was. So they're just not stuck in the UMIFA world where they're just not able to use those funds, period. Right. So and the last bullet point here is spending decisions. If you look at paragraph 4 of the UPMIFA, it says you should consider like these 7 things, whether you want to spend, do a distribution or not spend. So one of the last bullet points in the paragraph 4, it says refer to your investment policy statement. So they kind of point to each other, UMIFA and your investment policy. So MIFA wants you to kind of document internally like how your spending policy should be. If those gifts are negative, how does your organization want to address those kind of situations? So yeah, again, UMIFA, UMIFA, big difference, but UMIFA is definitely, uses that word prudent, and, you have to think of long-term of what these gifts are trying to do for your organization. Question 2, what qualifies as an endowment under UPMIFA? So an endowment fund is a donor restricted gift, and that is not fully expendable right away, and that's from the UPMIFA Act. So what's not included is these board designated or anything that's unrestricted is not covered under UPMIFA. So if it's not coming from a donor, then UPMIFA it's not going to really care if what you guys internally do with your unrestricted funds. So you can feel free to invest that how you want. And the gift instrument is a word that's in the UPMIFA statute. It's that's part of what an endowment is. It's a gift via a gift instrument. So whenever you receive one of these endowments, it would be good to understand what's on the gift instrument. Definitely get some legal advice to make sure everyone understands what the donor's intent is, and just make sure it's clarified and make sure everyone agrees that what the donor wants done with this gift is understood by the receiving organization. And kind of going along that last thought, if there's a conflict between the donor gift instrument and UPMIFA, which one should I follow? There are multiple instances in the UPMIFA where it specifically defers to the gift instrument. So, a good rule of thumb is that the donor gift letter prevails. So whatever the donor says in that letter, you must do. If the donor gift is silent, then that's where UPMIFA will come in and kind of provide some guidance on what you need to do with these donor gifts. So the UPMIFA also says that the receiving organization has to verify the facts relevant to the management and investment of the fund. So the burden is on the nonprofit to understand what's in the gift instrument, understand what the donor, wants you guys to do. And yeah, definitely use legal counsel, the board, investment committees, and so forth to make sure everyone's on the same page. Does UPMIFA require a nonprofit to hire an investment advisor to manage its investments? The answer is no. I kind of mentioned earlier that, the UPMIFA, you can hire, or you can use someone else internally or externally. You can, have someone on the board to act as the investment manager. I think the key here is to have someone who's qualified, have someone who's professional and what is very prudent and what has your organization's best intentions in mind, and you want someone that reflects well on your organization. So if a potential donor asks about who your investment manager is, you can say very good things about this person. So you kind of want to stay away from getting an investment advisor who's like a day trader or something of that nature. Someone who's a professional and maybe just believes in your organization. Maybe say a hedge fund manager may want to volunteer and be running your investments on a volunteer basis. So that's okay according to UPMIFA. So this is the number 5. So does UPMIFA require nonprofits to report endowment gifts? So UPMIFA doesn't require reporting, but each state has certain thresholds. So not all the states, but most of the states have a threshold where you're required to do an audit. For the state of Florida, it's $1 million. So if you have 1 million in revenue, you are required to do an audit. If you're required to do an audit, the auditors will notice some funds coming into your organization. And, if it's an endowment gift, they'll ask for the gift instrument to read it, make sure they understand it and it's accounted for correctly. So, and then when they produce the audited financial statements, there will be an endowment disclosure note. and they'll kind of flesh out, what the activity of what happened during the year. And then also on your Form 990, there will be, a section in Schedule D Part 5 where they'll kind of flesh out the same endowment activity. So anyone who reads your Form 990 or reads your audit financial statements will know that you have endowment, and that includes, the state attorney general, so they can kind of get, if they read these reports, they can see that you now have endowments. So key takeaways, for number one, nonprofits invest for various reasons. We went over 4 examples today. So, typically a nonprofit, would get a donation of some sort, like an endowment, and that kind of puts them in scramble mode. So that's kind of one, reasons why nonprofits invest. Number two, when you start your investment policy, just keep in mind that it takes time to get all of the players, your staff on board, the board on directors on board, the investment committee to get created, and have people to start meeting and, doing their due diligence. So that takes time. And then number three, nonprofits must, manage investments to be in compliance with the MIFA. So whatever is reported on your audited financials and your Form 990 will kind of be under the scrutiny of MIFA. So that concludes today's presentation. Are there any questions?
If you have any questions, feel free to unmute yourself or drop it in the chat.
Yeah, I do. John Duell, a treasurer for a small nonprofit in Oregon.
Yep.
Corvallis Sustainability Coalition. We've been around for about 15 years. We've got some ongoing investments. Some are more liquid, and we have a one endowment. But my question is, I'm new to the position, and I'm trying to build it's called a finance committee. And right at the moment, I can't tell you if finance committee includes investing, but there's no other investing part of the organization at this point. So I'm pretty sure the finance committee would make decisions about investing. So I'm trying to build this committee, and I don't think we have an investment advisor at this point, but I'm wondering if to build this committee, I've been asking some of the banks that we have funds situated in, to see if I can recruit somebody to join the committee. But I'm wondering, is that a wise thing, or should we, and I'm also wondering, do investment advisors offer their services pro bono? I'm thinking the independent ones, from, that are professional financial advisors. What are your thoughts on that?
Yeah, so you can go that direction. I mean, I would kind of maybe reach out to some of your peers, other nonprofits in your area, to see kind of who do they use, or who do they recommend, as a financial advisor. You can also reach out to your local community foundation. They have a lot of resources. They can definitely help you going in the right direction. And, obviously with anything, if you want some kind of full service, they'll start, there'll be some fees associated with that. But I would start, with the community foundation, and kind of reaching out to peers, just kind of networking in that sense, to kind of see what options are available in your local area.
Great. Thank you very much.
No problem.
Any other questions? Right. Well, if you think of anything or have any questions, I think James, you shared your email.
Yep.
But a big thank you to you, James, for sharing this incredibly informative and timely presentation. And thank you to everyone that has joined us today. As I said, we'll be sharing the recording on our website and emailing it to you, as well as the slides, so you can have a reference. Keep your eyes out for upcoming free webinars that get posted on our website. And if you're on our newsletter, we will be sharing that information on there as well. So I suggest you sign up. And that is all. Have a great afternoon, everyone.
Thank you.
Bye-bye.